Hello everyone, the stock market fell last week as investors start weighing the risk of a global recession in 2023. Something worth highlighting is that the S&P 500, which represents the broader market, fell below the crucial support level of 200 moving average again. What didn't help is that the producer price index, aka PPI, came in a little hotter than expectation. So in this video, I will be sharing my views on where the market is currently standing as we enter a huge week with CPI data and FOMC meeting. While movement can be and should be expected, do watch on to find out more. Last week, majority of the stocks ended lower on Friday with major indices falling. Specifically, Dow Jones fell 2.77%, clocking its worst week since September. The S&P 500 dropped 3.37%, while the Nasdaq tumbled close to 4%. The weakness in the market could potentially be attributed to a few things, for instance, a high probability of global recession next year, or the ever-sticky inflation, especially when last Friday's PPI data came in higher than expected. It could also be somebody knew something in view of next week's CPI data release, or it could well be institutions adopting a risk-off approach by selling stocks and preserving cash. To be very honest, nobody knows the actual reason. The media or any analyst or individual can paint any picture that suits their thesis. For instance, despite the hot PPI data, one could argue that inflation is showing signs of cooling because the annual wholesale inflation rate has eased from 8.1% to 7.4%, and the core rate fell from 5.4% to 4.9%. Anyway, the PPI is just an appetizer for next week's CPI data release. This is probably why the market did not react too much on Friday. And as they always say, market is forward-looking, and that could be the reason why the market has already started selling since last Monday, before the PPI data release on Friday. Looking ahead, all attention will be shifted towards Tuesday's CPI data release for the month of November, which is expected to show whether inflation has peaked. Personally, I must say this coming week is one of the biggest weeks of the year, as the market is anticipating a lower than 75 basis points rate hike when Fed ends their FOMC meeting on Wednesday. Okay, but just imagine, November's CPI comes in hotter than October's 7.7%, and the Fed decides to stick to 75 basis point hike. I think it will be pure madness and chaos in the stock market. I mean, yes, investors are hoping for a pivot or a less aggressive Fed in terms of monetary tightening, but the issue now is the recent data points have failed to support that hope and desire that investors are having. So whether is it 8% or 7%, there is still quite a fair bit of difference and delta between this number and what Fed is hoping to achieve, which is around 2%. Anyway, as shared earlier, expect some wild movements and swings this week, and I would urge investors or traders to stay out if you are not confident in navigating through the volatility. Lastly, I would think this week will set the tone for the rest of December and determine whether the stock market will have a center rally or not. Okay, now let's move on to the technical segment. Couple of things to dissect and highlight just for SPY alone, and I think it's really important because it represents the broad market, so do stay on. First up, in my last video, I shared that SPY has hit the downward trend line that started from January 2022 and that we got rejected during the last two occasions where this trend line was tested. Now check out how SPY is playing out just like the previous times. I claim no credit for this as I only presented what I saw last week and the probability of certain movements, so those who caught the downside, congrats to you, it's your credit. Next, I also shared that SPY would likely move around a tight range last week, probably around 393 to 400-ish, and it indeed was trading within this range. The reason is very simple. Retail investors cannot move the market drastically. We just don't have the volume. The institutions were likely watching by the sideline last week and waiting for the upcoming CPI data. So come this week, let's say we get a good CPI number and the market decides to go up, watch out for the 200 moving average at 400. That will be the first resistance that SPY needs to clear to be slightly bullish. Note the word slightly. Next, it needs to go above the powerful red dotted trendline convincingly. Note the word convincingly. So what does that mean? It means SPY needs to break above them, retrace to retest it a little bit, and go up again. That will then be a sign of a very bullish move, and we could get our year-end center rally. But say if CPI prints badly and on the downside, the probability of us slicing through the support of 389 is very high, as there is a high chance for us to fill that big gap from the last CPI between 381 to 385. This also means that we are back to square one, or at least back to where SPY was last month. Okay, some interesting stuff that I saw, there seems to be this cute little mini bearish head and shoulder pattern formed each time we tested the downward trend line. It does appear that we are having one again. If you notice, in the previous two occasions, this pattern was followed by a decline. So third time's a charm, or are we going to slide down again? All I can say is, no need to predict, let CPI number and the market determine its direction. Personally, I think this week SPY will move out of the tight range we mentioned earlier. It's either we go to 380 and below, or we break above 400. Probably nothing in between. This is just my wild guess and not a financial advice, okay? Okay, one last interesting thing on the chart, check out the MACD. The two times when MACD crossed down above the baseline, we had a huge decline. Again, this is the third time that MACD is crossing down in that zone. Well, not saying it will fall again, but I think it's worth paying attention to it. And oh, by the way, do you recall last week I shared that there is a potential double bottom on VIX, which is a bad sign for the market? Seems like the double bottom is playing out, and it wasn't surprising that the market fell as such. For this week, watch out for this yellow dotted trend line. If VIX gets above it at around 24, good luck to the bulls in the stock market. Okay, so with so many bearish signs, does this mean it's for sure that SPY will go down? Honestly, for me, I will not take any side until CPI data is out and Fed had announced the next rate hike. Okay, let's move on to Apple. Last week, I shared that there is a triangle wedge pattern forming on the chart, as shown by the two blue lines. Immediately on Monday and Tuesday, Apple tested both the top and bottom of the triangle, before breaking down in the next 3 trading days. So purely based on the chart, Apple is looking slightly bearish. Note the word slightly. So what's next? Next, watch how Apple tests the bottom blue line of the triangle. It is currently trying to get back into the triangle wedge pattern. And if the retest fails, then Apple is looking very bearish, and we could have a chance of filling the gap at 138.5 to 139.5. There is a little support at 138 though, but to me, 134 support is more important. If that doesn't hold, then sub 130s could come into picture. Personally, I am standing by to pick up some shares at 130s range. On the upside, it needs to get back into the triangle wedge. Breaks above it, breaks above 150, then we can consider Apple to be bullish. The more critical resistance is actually the 200 moving average, which currently sits at 153. The reason is very simple. The last 2 times Apple broke above this level, it flew up. If that happens, I think we could go as high as 160. Next, the super volatile stock, Tesla. Something interesting to share again. I noticed that for almost the entire month of October, Tesla was trading at a specific range, around 200 to 222. Then in November, it seems to be trading in the second zone between 166 and 200. Now I start to wonder if we will form another zone from now till early Jan. Anyway, Tesla is looking weak at the moment, with the MACD losing strength and could have a bearish crossdown anytime. But to clarify, it has not happened yet. And again, I think CPI will play an important role on whether the MACD will cross down. Also, something that caught my attention is that the Bollinger Band is getting tighter. For those who doesn't know what this means, it means a huge movement will likely happen. Don't ask me which direction because I don't have a crystal ball. That being said, I think it's a good info to know because the next movement could be strong, and that is when investors or traders can ride on that direction. I myself will be watching very closely for option trading. With a potential wild movement coming up, I think it's either we get to 150's range or we fly above 200. Watch out for the 52-week low of 166 as a support on the downside, which I think is a weak one. As for the upside, keep an eye on the first Fibonacci retracement level at 201. If that breaks, and if Tesla goes on to reclaim the 50 moving average at 205, then we could potentially stay in this zone of consolidation of 200 to 222 till year end. Unless of course Elon Musk does his usual eccentric stuff again. Moving on to Tesla options, I had closed a sell put contract last Friday. To be honest with everyone, I did not expect Tesla to drop that much last week, And I must also admit that a little luck came into play when we had that rally on Friday to salvage my option. Because at one point my option was sitting on a huge loss and I was prepared to roll the option. So lesson learned for everyone, remember to take profits. And also option is a risky trading tool, please exercise caution. Anyway, if you are still sticking around this segment or still interested in option, a quick update on my 2 other sell put options contracts. They are looking good so far, but again with Tesla anything can happen. I mean, falling from the current 180 to 150 is possible in Tesla's context. And that will definitely affect that option contract that is expiring this week with 150 as strike price. So I will be watching the market quite closely and will close the contract when necessary. Lastly, I am planning to write or sell another put contract after the market finds its direction post CPI and FOMC meeting. Let me know in the comments section if you wish to be updated on this. Okay, now let's talk about Google. A quick observation shows that the MACD has just cut down and that is a bearish sign. At this rate, we could be on the way to fill that gap at 89 to 91 with 90 as the support. Once this zone breaks, the other tiny gap at around 86 could act as a magnet to pull it further down. At this point, Google does look bearish, and I had missed the opportunity to sell a covered call. With that being said, don't be too surprised if we had a little bounce as we already had 4 straight red candles. But in my view, anything below 100 still looks bearish to me. To add on, it seems like 100 is a crucial level which Google has difficulty breaking above. Okay, to wrap this up, I have seen and received this question quite often whenever a CPI data is about to release, and that is, how do you think the stock market will move when the data is out? Will it go up or down? So before you exit this video, I thought to share my view again with examples. All I can say is my take or view has always been, don't predict or at least try not to. I know it's tempting because I am guilty of doing that too. Therefore, I have to constantly remind myself not to do that. So basically, let the market makers go first. I mean, why buy or sell stocks or options right before the CPI data is released if you are a short-term investor or trader? This is a 50-50 probability game, and the volatility swing could wipe out your options or stock price. How about considering letting the CPI data be announced, let the market react, let it swing for a little while or wow, and once you have more or less identified the trend and direction, right along with it. But of course, it will be a different ballgame if you are a long-term buy and hold investors. I mean, if you are one, this short-term volatility should not bother you if you are invested in fundamentally great companies. Anyway, here's an example. During the last CPI data release date, which is 10 November, SPY opened 388 and closed at 394. The next day, it closed at 398. And then it chopped around this range and finally hit the high of 410. Therefore, during this period, if you are a trader and had entered anywhere below 400, you would have profited on its way up. Yes, it did come back down last week, but again, as I have always emphasized, traders should always learn how to take profits. Okay, one more example. On 13 October, CPI data was released and the market rallied from 349 to 365 for SPY. It then went on to hit 390 in the next 2 weeks. That's about 25 to 40 points upside. And you had plenty of time to enter during that period to ride the uptrend. So you get what I mean? Just imagine you had predicted the market to go down and you shorted it at 349 before the CPI data was released. And then the market rallied 40 points up. Your position would have been wiped out. Therefore, my personal view is why guess or predict the market direction before the CPI data is released? Why not sit back, relax, wait for the data to be out, let the market moves, and then you move along with it. Alright, I really hope you have learned something from this video. If so, can you just comment something or anything below please? Please also help to hit the like and subscribe buttons if you haven't. Thank you very much.